With more than 6,000 small and micro-cap companies listed, if you're looking for the next Apple at the earliest stage, then ChannelChek truly is the orchard. The listed companies support ChannelChek, so it's free for you, the potential investor, to gain access to institutional quality research from FINRA licensed analysts, advanced market data, industry reports, news, and a growing catalog of videos and webcasts. Make sure to subscribe to our YouTube channel and register for ChannelChek so you're always up to date on what's going on at the small and microcap data place. Welcome to the virtual Roadshow series presented by ChannelChek. This Roadshow features Bill Wilson, CEO, and Stuart Rosenstein, Executive Vice President and CFO of Townsquare Media, NYSE ticker symbol TSQ. Following a formal presentation, they're joined by Michael Kupinski, Senior Research Analyst for Noble Capital Markets, a FINRA-licensed SEC-registered broker-dealer, for a Q&A session featuring questions that were submitted by the live audience. You can find Noble's research on Townsquare on channelchek.com or by clicking the link in the description. With that, I am pleased to present Bill and Stuart.
I'm incredibly proud today to share our results to date. I'm very excited about the future of Townsquare. As hopefully you've noted to date, the pandemic accelerated Townsquare's transformation into a digital-first company with an increased focus on local content, local businesses. And our flywheel continues to pick up momentum, and I hope over the next 45 minutes, you will come away recognizing that Townsquare has a unique and differentiated story driven by a unique and differentiated strategy. So with that, let me jump into the slides. As again, this is our investor deck on our corporate website. An introduction to Townsquare. Important to note that we're the leading local media, digital marketing, and live events company focused on hundreds of clients, hundreds of mid-sized and small cities across the US. So we're specifically focused on markets outside the top 50, where there's really a dire need for content, local content, as newspapers has retrenched and TV has started to cut back in those markets, and a lot weaker digital competitive landscape, which we're taking advantage of. We're going to go into our digital marketing solutions business, which is a clear differentiator for our company, as well as digital revenue overall. And based on our digital strategy and morphing into a digital-first company, we've been able to outperform our traditional broadcast peer group, although we're looking to be pivoted into a digital peer group in the future. Just some key stats in terms of scale. On a trailing 12-month basis, $400 million in revenue, $95 million in EBITDA. As I just noted, really important to note, $180 million in digital solutions, which is a little under half of our total revenue. Proud that in the first half of 2021, we in essence had 103% of our 2019 EBITDA. You could see that we reached 59 million people, unique individuals on the web, and 11 million people on our AM/FM broadcast. So I'm going to spend a few minutes going through each of our segments. Our reporting segments and our financials are broken out as advertising, Townsquare Interactive, and live events. So in terms of advertising, it's made up of digital advertising, which is driven by two unique product groups, Ignite and AMP, which I'll talk about. You can see here that's $104 million on a trailing 12-month basis. And then our traditional broadcast AM/FM business, which is $199 million ex-political on a trailing 12-month basis, and really a mature business, a great cash cow that allows us to invest in our digital business. And what I'll do here is I'm going to jump into each of these components. So advertising overall, $323 million. Townsquare Interactive, really important segment of our business, really important hidden asset, hidden gem, I should say, becoming more and more recognized by investors. It's a digital subscription business, which I'll get into, and then live events. So let me start with our two digital advertising components. One is called AMPed, which is monetizing our owned and operated properties. On the bottom right, you can see our unique visitors over the last 10 years have literally grown from 1 million unique visitors to just under 60 million. And we've been able to grow our digital advertising by monetizing this audience in very unique ways, to the point where over the trailing 12 months, you'll see on the key stats on the right, AMPed is $45 million on a trailing 12-month basis. So this is over 330 local websites, almost a dozen national entertainment brands like Loudwire, XXL, Pop Crush, and each of our brands also has a dedicated mobile app, which is integrated into Apple CarPlay, Android Auto. So as soon as you get into a vehicle, you can also listen to our stations. So very important segment, particularly as I noted earlier, in our size markets, focusing on markets outside the top 50 cities, there is really the term has become news deserts. So local communities are having to really search out trustworthy news sources, and we've come in and filled that void, and that's why our online audience has grown as much as it has, and given that size of audience growing, we've been able to grow our revenue accordingly. So a nice growth in digital advertising. The second component of digital advertising for Townsquare is Townsquare Ignite, which is our programmatic digital offering. This is approaching $60 million on a trailing 12-month basis, and is one of the fastest growing solutions in our advertising segment. We are our own demand side platform. So we're literally becoming a digital agency, or have become a digital agency for our local clients in markets outside the top 50 in the United States. So we help the local client craft the message. What's the right marketing message? We then actually build the creative for them, and then we serve that creative to the right individual at the right time. So this could include any connected device. So we're now selling quite a bit of over-the-top television, social media, targeted media in terms of mobile and geofencing, all of those things. So we'll sit down with a client and say, describe your ideal target customer. If you could reach more of this type of customer, tell me what they look like. What are they interested in? So a jewelry store in Tyler, Texas, say I'm looking for men 40 plus, household income 70,000, who are interested in sports and are car enthusiasts. We'll then help create that message and then serve that target profile across the internet and any connected device. And it's a very powerful solution. As you're probably aware, digital programmatic advertising is the fastest segment of digital advertising in the United States. And with digital advertising now comprising over 50% of all advertising, it's a great place for us to be. And as I noted earlier, we have a significant competitive advantage here because A, we have our own inventory because we're our own publisher, so we're an at-scale publisher. And then B, we're integrated literally with 1,000 exchanges. So the amount of inventory we can see is unparalleled, particularly in our size market. We're usually competing with a digital agency who may sign up for Google Display Network or be buying Facebook ads, so that much limited amount of inventory. So the ability to reach everybody as well as optimize that campaign over time is limited. Where for us, we're one of the largest in-house trading desks in the US. And then when you factor in that we're targeting cities and markets outside the top 50, it is a clear competitive advantage for us, and one of the reasons why this segment of our business is one of the fastest growing in the company. The third component of advertising is our broadcast advertising. So this is our traditional business. This is how the company was formed in 2010. This is monetizing people who are listening to our AM/FM broadcast, which, as I noted earlier, is $199 million ex-political on a trailing 12-month basis. We are the largest operator of radio stations outside the top 50 markets. So we have 322 radio stations, all of them outside the top 50 markets. As I noted earlier, we have 11 million people listening to our AM/FM signal every week. As you're probably aware, radio over the last 5 years has become the #1 reach vehicle in the US. It used to be television. Television used to reach 96% of Americans, and now radio has surpassed television. Radio reaches 93% of Americans on a weekly basis. As you probably are aware, television's fallen into the low 80s and continues to decline. So it's a great top of the funnel brand awareness solution for local clients. The industry at large in terms of broadcast has done quite well in terms of reach. Where the industry has struggled overall is time spent listening, which has been declining the last several years. The good news for Townsquare is based on our investment in local content, and I believe based on the markets that we're focused on outside the top 50, our listenership has been incredibly stable. And as you can see on the right, we reach 1 and 2, 50% of the adult population in the 67 markets that we have AM/FM radio stations in. So to be able to sit down with a local client and say, on average, we reach 1 and 2 people in the community is very, very powerful, and a great, again, top of the funnel brand awareness in terms of the ROI, to me, unparalleled. So to recap advertising, Digital advertising, two components, Amped and Ignite. Amped is monetizing our own audience. Ignite is programmatic advertising across any connected device in the US. And then the other component of advertising is broadcast advertising. I'm going to pivot to the next segment of our company, which is Townsquare Interactive. As I noted at the top of this call, really a hidden gem. I've been with the company since 2010. I joined as a chief digital officer at that time. I had spent the prior 10 years as the president of AOL Media, so well-versed and quite experienced in digital media in terms of building audiences and then monetizing audiences. And when I originally came to Townsquare, it was obviously based on broadcast assets. And when I moved into the CEO role in 2017, 2018, and I started to meet with investors, which I hadn't done before, I recognized Townsquare Interactive was really a misunderstood segment of our business, and partially our own fault, because up until 2018, we did not provide the financials as part of a segment. So first thing I did when I moved into this role was immediately break out the financials so they could be audited in terms of revenue and profit for Townsquare Interactive. So for trailing 12 months, it's $76 million and $23 million in profit. So we operate this business at roughly a 30% profit margin. So what this business is we go to local SMBs, again, outside the top 50 cities, and we handle all of their digital presence online. So we build their website. Building their website means we do all of the copywriting, all of the photography, all of the design. We do directory listings, reputation management. We do all their social platforms. So not only do we set them up on TikTok and Facebook and Twitter, but we'll actually produce the content on their behalf if they'd like. And we handle all of that as part of a subscription. So average ARPU, as you can see on the right, is $300. So we take $300 on their credit card every single month, and it's a recurring revenue stream. This is the only segment of our business where we have two distinct sales channels. We leverage the sales teams in our 67 local markets, and then we also have built an inside sales team in Charlotte. So in Charlotte, where Townsquare Interactive is headquarters, there's 600 employees with roughly 200 in the sales force. And we've become very proficient in not only selling this solution in our markets, but as you'll note on the left-hand side of this slide, 57% of all of our subscribers are actually outside of our local market footprint. And we're doing that through an inside sales team based in Charlotte. To accelerate our growth here going into 22 and 23, we have announced on our last public earnings call that we'll be opening a second location for Townsquare Interactive on the West Coast in the first half of 2022. So couldn't be more proud of our results here. You can see we have just under 25,000 monthly recurring subscribers today, and you could see the growth of our revenue on the bottom right. In essence, we've grown this business on average $10 million top line, $3 million bottom line for the last 5 years. And it's quite a competitive advantage for us, particularly in these markets. To talk about the total addressable market for a minute, if you look at all of the businesses in the US, there's a little over 28 million. If you exclude the top 50 markets, there's a little over 11 million. We then focus on companies with less than 20 employees and less than $5 million in annual revenue. And then we exclude certain verticals that we know are not ideal for this solution, like realtors, banks, auto dealers, and we get to a total addressable market of just under 9 million. So if you take that 9 million, or 8.8 to be specific, times the $300 ARPU on average, you're talking about a $32 billion total addressable market. And we're sitting, as you can see on the prior slide, at just at 76 million on a trailing 12 months. So the runway here is incredible. We've consistently added over 850 net subscribers each quarter for 13 consecutive quarters. Our last quarter in Q2, we set an all-time record of 1,350 net subscribers. So couldn't be more bullish on this business going forward. We've shared that this business will be $100 million within 2 to 3 years, and based on our trajectory, I believe that'll probably be on the shorter end of that, if not sooner. So this business has performed quite well for us for many, many years, all built organically in-house. So if you look at our Townsquare Interactive combined with our digital advertising of Ignite and Amp, that in combination is our digital revenue. So you can see in the first half of 2021, our digital revenue increased 24%. What we expect this year, so on a trailing 12-month, we're at 180 million at the end of Q2. We expect $190 million or more on a full year basis. So just to put that in perspective, looking at the slide on the right side, you can see in 2017, we had less than 100 million in digital revenue. And this year, a few short years later, we expect to be at 190 million. And importantly, we shared on our last public earnings call, we expect to be at $250 million in digital revenue within 3 years. To put, if you're an investor who is familiar with the broadcast space and hasn't recognized our digital first transformation and maybe stack us up against other broadcast companies, you can see on the bottom left, other large-scale radio broadcasters all are under 25% in digital revenue as a percentage of their total revenue. So you could see, Beasley and Cumulus under 15, and Odyssey and iHeart just over 20. And first half of this year, we're at 47%. So again, digital has become the growth engine of the company. We love local broadcasts. We believe, and I believe, the combination of radio and digital, we would not have the digital success we've had for the last decade without the power of the megaphone and the companionship of local radio. So it's a unique combination. It's a unique strategy, and it's also unique in that we're focusing on markets outside the top 50. So I just want to recap two things, and then I'm going to turn it to Stu to hit our balance sheet, and then we'll open it up to questions. So prior to Q2, you could see what we said, and then you could see on the right side what we delivered when we announced our earnings just about a month ago. So, we beat, in essence, on every line item, from adjusted EBITDA to total net revenue to broadcast revenue to digital advertising revenue to Townsquare Interactive subscription revenue, and our total digital revenue in Q2 grew 36%. So we're really proud of our results. More importantly, we're excited about where we're going. And so to that point, just to let you know what we shared about Q3 and full year, we said that total net revenue in Q3 would be up 11 to 14% year over year, but we're really focused on comping against 2019 given the pandemic of 2020. So full revenue, including live events comp, we expect to be down from Q3 2019, -3% to -6% is what we said on our last call. We expected Townsquare Interactive to be up 15% year over year in Q2 revenue. Live events Q3 revenue, we expect to be about 3 million, so limited number of events, but at a 20% margin. And then in terms of adjusted EBITDA, on the high end, we actually expect to match Q3 2019, and on the low end, be -3% to that. So we're quite proud of how we've managed our expense base, and as I noted before, on a first half of the year basis, actually above first half 2019 EBITDA. And then full year, on our last earnings call, we actually increased our net revenue guidance by $15 million. We're $395, and just based on our strength of what we were seeing in the back half of the year, we raised that to 410 million on a full year basis, which all in, including live event revenue, would be 95% of 2019 levels. And then total digital revenue, as I noted before, 190 million, which would be a growth of 17%. And then really proud that we said adjusted EBITDA full year 2021 will match 2019 levels, even given the headwinds still with auto and chip shortages, and obviously continued suppression with the Delta variant of some live events, not only for us, but from advertising and so forth. So that is our expectation for Q3 and full year. It looks like we may have lost Stu. I know he was on earlier as we were in the waiting room. But Michael, why don't we, I'm sure Stu will rejoin, maybe as part of the Q&A, we can cover the fact that we redid all of our debt in the beginning of this year. So we have one tranche bonds, about 550 million. And we could talk about our stock buyback from Oaktree, which was highly accretive to our shareholders. And then I'm sure Stu could touch on our free cash profile and the fact that we'll be delevering through this year and next year. So Michael, I will introduce you. Glad to be here with you as always, and open it up for Q&A.
Well, I appreciate that. First of all, obviously, I think our viewers can appreciate the company and know why now I view Townsquare and have been viewing Townsquare as one of my favorite stocks. Before we get started here, I want to remind everybody that they can ask questions, and if they want to type in the questions in that little chat box on the side there, I will get to as many of your questions as I possibly can in the time allotted here. So feel free to type in your questions and send those away to me. So obviously the company has been benefiting from a very nice recovery here, Bill. And I think what's really nice about the company in that you've over-delivered on the recovery is that how you set up for this during the pandemic, I think, is instructive of how you're coming out of this, out of the pandemic. And I think that I was wondering if you can maybe chat a little bit about the things that you did. And one thing that I'll quickly note is that you didn't lower advertising rates. And I think that's really important because it always takes a long time to kind of recover those advertising rates if you do drop them. And so I'm just curious on, in the past, I followed the industry, of course, many decades here and gone through cycles. Was it because of your markets, how they were affected by the pandemic? Was it because of the fact that maybe you have limited competition? What were the reasons why you were able to keep your rates versus many others that really weren't as fortunate?
No, it's a great question, Michael. Thank you. Twofold. I'm gonna answer your question, but I do want to note that we did take a very different approach when the pandemic began, really in March, April of 2020. A lot of people in the traditional broadcast space, be it television or radio, really cut their workforce dramatically, particularly on the radio side. We made a conscious decision to make some strategic cuts at the corporate level, but our greatest asset in the company is our talent across the company, across the United States. And we spend a tremendous amount of investment in time and energy retaining our best talent and recruiting the best talent in our market. So we didn't want to have a self-inflicted wound. We knew we could generate operating cash even during the pandemic. So we consciously decided to hold on to our team. And I think, quite honestly, that's the biggest driver of our rebound. If you go back to our earnings script in 2020, we consciously said, hey, we're making this decision. We're going to hold on to our team. You're not going to see as much expense reductions as maybe others in the peer group because we want to be well positioned for the rebound. And you're seeing that now. I think we're one of the few people in the broadcast space who have matched their profit of 2019 in the first half of 2021. So specifically to your question, you're 100% right. Our average minute rate from a traditional broadcast perspective is equal to our 2019 level. So it really wasn't based on market size because our competitors in our markets did drop their rates. And we made a conscious decision because of the brand equity and the heritage of our brand, in combination with we are one of the few broadcasters who continue to hire local on-air talent. So given that investment in local on-air talent and given the fact, as I described before, we reach 50% of the adult population on our AM/FM broadcast, we could have that rate integrity. So our decline in broadcast through 2020 and into 2021 was a matter of number of clients. We kept the rate the same. So as more and more clients come back and as the recovery continues, the economy is taking off, we're well positioned because we didn't drop that rate, because it is very hard once you do drop rate to bring it back up. And given the strength of our brands, given the strength of our local talent, we're able to keep our AMRs flat to 2019 levels.
We have a question coming in here. Intuit announced the purchase of Mailchimp, and the question is, in what ways is your digital business similar to Mailchimp services, and what other digital service offerings are you doing, or are you looking to provide to your existing and future customers? And what is the ability of the company to expand its TAM by pursuing larger size customers?
Yes. So yeah, I saw that this morning. I think it was a $12 billion acquisition of Mailchimp, and we actually, it's a great solution in terms of email marketing for SMBs, and that's obviously why Intuit saw it as valuable to be able to not only provide tax services, but then to do email marketing and such. So we actually already offer email marketing for our Townsquare Interactive subscribers. I didn't go through everything on that slide, but you may have seen we do appointment scheduling, we do virtual classes for businesses. In essence, any business need, we can step in as it relates to that digital presence. and provide, and email marketing is a core attribute of that. You know, in the future, we've looked at providing other services outside of digital presence solutions like payroll, HR, which we have not done. We've explored, but we have not done. In terms of going after larger customer bases, we don't see a need to do that. If you look at that, you know, 8.8 million target addressable market at $32 billion for Townsquare Interactive, we're very, very disciplined. You know, I think one of the core attributes of the company is we're very disciplined and don't get distracted chasing something outside of our core discipline. So we know SMBs are a perfect target market for us. There's just under 9 million, 32 billion, and we see a competitive advantage that nobody else is offering the types of services that we are offering in our markets at that price point. Where if we go upstream, there are digital agencies we compete with who may have 30, 40, 50 large clients, but we're going at scale. We're bringing national world-class solutions into local markets. That one of the reasons it's growing as fast as it is we think it's highly differentiated and defendable.
And Bill, I would like to chat a little bit about your programmatic business, Ignite. You know, it's interesting that Ignite carries such high margins, and I know a lot of other programmatic businesses aren't as fortunate to carry those margins. Can you kind of give us a flavor of, do you believe it's because you're utilizing your own inventory? How much of your inventory on a programmatic basis are you using to kind of create the higher margins that you're enjoying?
Yeah, it's really threefold. So we use a minority amount of our own inventory on the programmatic side. One of the great assets and value differentiators for us is our own inventory allows us to collect first-party data. So in our size markets, you know, we have over 15 million profiles. I didn't go through it as part of the prepared slides, but it is in our investor deck. It's called Data Squared. Starting in 2014, we've invested literally over $10 million in a data management platform that provides unique identifiers and profiles of roughly 15 million individuals. And in our size markets, I believe we therefore have the largest profile of the people living in those cities. So the fact that we've got that first party data is a clear differentiator, because anybody we're competing with in those size markets is using third party data exclusively. And we're marrying first party data that's exclusive to us with third party data. So that is one of the reasons that we can operate this at a margin profile that is so differentiated from others, as you mentioned, Michael. The other component is because we're integrated with 1,000 exchanges. So, you know, often we're competing with an agency in town, as I mentioned in the prepared remarks, who has Google Display Network or buying Facebook ads or maybe using Trading Desk. We're integrated with 1,000 exchanges. So the ability to optimize the inventory and buy it in real time at less rates because we're seeing all of the inventory. So the level of supply is so much greater than a competitor is one of the other reasons why our rate integrity and our profit profile on Ignite is as strong as it is. So yes, we're our own publisher, but we don't use the majority of inventory programmatic. We actually use less than 10% for programmatic, but it does help us with first party data, which is a differentiator that appends with third party. And then the fact that we're integrated with the level of exchanges we are, it allows us to buy the inventory cheaper, as well as optimize it so the performance is higher than our competitors, is a key differentiator for us and a driver of that margin.
And Bill, it seems like there's some disruption going on tracking at this point with the iPhone, you know, kind of at this point asking their customers to opt in if they wanted to be tracked. And at least one radio executive commented that given the fact that now Facebook isn't, having a lot of conversion data, that it's almost like they're on a level playing field with radio. So just wondering if you can offer your comments about whether or not that actually levels the playing field for radio, and then also if maybe your digital businesses might be affected by the lack of tracking data that's coming out of Apple, for instance.
Yeah, I saw that comment yesterday. I totally agree with my colleague in the industry that it definitely levels the playing field. So it is an advantage as it relates to specifically broadcast. As it impacts our digital, so it's good for broadcast. To his point, I concur. As it relates to the digital business, as I just mentioned, if cookies go away and identifiers, or they talked about Google Chrome going away, they just suspended that for at least a year. But when and if, I believe it'll be a when, not an if, these tracking cookies are limited to, or go away, we are in such a competitive advantage as a publisher. If you look at our growth of audience of just under 60 million, and as I mentioned, we have 15 million, which we refresh every 30 days, so it's very fresh first-party data. I am confident that nobody in our markets, as a publisher, be it print, television, other radio, standalone digital properties, has as many profiles, has as much first-party data on their own audience, their own community members as we do. So if cookies go away and therefore third-party data goes away, we are in an incredibly competitive advantage because we've invested in this since 2014, having this data management platform. So although I don't think it'll happen soon, when it does happen, we are incredibly well positioned.
Pivoting back to radio in terms of the advertising recovery, you mentioned that you are near 2019 levels already, which is amazing. But there are obviously probably some categories that are still lagging your 2019 levels. And I was wondering if you can just talk a little bit about some of those ad categories that have not performed well, and do you think that those will recover, and in what time frame? You mentioned a little bit about auto, and we can talk a little bit about auto, but can you just kind of give us a sense of some of the categories that might be lagging a little bit that you might think could start to see some sort of rebound as the economies are opened here?
Yep, auto is by far and away the largest, and that's been driven more by the chip shortages and the inventory shortages. We've benefited from recruitment for auto in terms of mechanics and used cars and things like that, because there is a need for that. As you probably know, there's a lack of new car inventory out there. So that has definitely been a headwind. And based on what I read and what I hear, that probably is there for another 9 months into the back half of 2022. So we'll see. Other categories, probably the second largest headwind is just live events, things that are happening in our communities just based on COVID. People either didn't plan for doing an event in 2021, or because of the Delta variant, maybe pulled back in doing some of the events. So not only our own business has been impacted, as we noted earlier, but it's a bigger impact. Live events for us is a really small part of our business. It's in 2019 less than 20 million. It was around 16 million in revenue and about 3.5 million in profit. So less than 5% of our revenue. So very, very small, but it's a strategic asset for us. So we utilize it to do on-site activation for clients. It gives us full funnel activation for local clients, which is a differentiator for us. But it is a bigger part of our advertising pie. We get a lot of advertising from state fairs, local concerts, things like that have been a headwind and continue with some level of uncertainty around events into the back half of the year. So really, auto and events have been the largest. Obviously, as the economy's picked up, retail's really picked up. As I mentioned, recruitment's definitely a hot category. You probably have seen from others in the space where sports betting has become legal. Those states are taking off. So quite a bit of tailwind, a little bit of headwind with events and auto.
And can you talk a little bit about Townsquare Interactive as well, Bill, regarding categories? Because obviously the restaurant industry really had taken a big hit, and was just wondering if you can give us some thoughts about categories that businesses that might be that you might be seeing rebounding at, because obviously you're seeing very strong growth and an acceleration in growth in your Townsquare Interactive business. So can you give us a flavor of what's happening there?
Yeah, it was really eye-opening to many people internally, to our team members internally, just that when the pandemic hit, advertising across the board in Q2 2020, pulled back. There was so much uncertainty with shelter in place and government shutdown. Yet through all of that, Townsquare Interactive grew every single month, not only every quarter, literally grew every single month, double digits revenue, double digit profit. And I think the pandemic served for local businesses externally. It spotlighted the need to control your web presence. So if you had a Facebook presence and you were hoping to communicate to your audience that, hey, now you're no longer doing in dining, but you're doing curbside pickup, or you've never done deliveries, but now you are, or you were a gym or a yoga studio or a therapist and you only did in office and now you're doing virtual, all of those things, you needed a great web presence, and you also not only needed a great web presence, you needed to communicate to your consumers directly. So the pandemic served to show to these SMBs that you need to really have a great web presence, and if that's lacking, it's going to really hurt your business. So in many ways, the pandemic spotlighted that need for SMBs and allowed us to really hyper grow Townsquare Interactive, and really was one of the key decision points to open that second location in 2022 in the first half. We're targeting probably end of Q1 at this point. But from a culture standpoint, internally, we've always been a digitally focused company, but the pandemic transformed us into a digital first company. And what that means is it recognized throughout the organization, regardless of what role you play, you knew the growth engine of the company was going to be digital audience, digital revenue, digital profits. And although we love and embrace our broadcast roots, it's a mature business, it's a cash cow business, and that our future growth is all based on that. And Townsquare was really a lightning rod internally to show that even in the depths of March, April, May, June 2020, we were having strong retention, as well as a lot of new customers coming in who we've never had before. And that's why, that's at the point where we actually started to show this total addressable market slide that I shared today, that it is so robust. It's really how quickly can we move and operate and scale, because the market opportunity is so significant.
And I'm going to just add a couple of things to the questions that are coming in here. So your debt is under control. I don't, if I recall, it's not due until 2026, if I'm correct. And so you're going to be generating a lot of cash flow, especially as we go into next year with a little lift out of the political side of the equation. Can you talk a little bit about allocation of capital at this point? Talk a little bit about the M&A environment, what your appetite might be for acquisitions, and what are your thoughts in areas of acquisitions that you might seek?
Sounds good. I'm going to do a mic check. I see Stu, but Stu,
Yeah,
if we can hear you. All right, can you touch on the cash flow, and also, since we weren't able to touch on earlier, just about what Michael just mentioned, just the debt structure and the share buyback, that'd be great.
Yeah, absolutely. So, as a lot of terrible things happened last year, one great thing that came out of this was we had the opportunity to buy back 100% of Oaktree's shares of the company, which alleviated the overhang on the equity, which was a big hindrance to our stock price. We bought it back at a tremendously low price. It was super accretive. I think everybody saw how the market reacted, so that was something that was really good. We had cash on hand to buy their shares back, so we didn't have to go out and increase our debt at all. We're going to probably end this year with $40 million. Our free cash flow is really strong, and our free cash flow conversion is strong. So on an annual basis, we have $38 million of interest expense. CapEx will be under 13 or somewhere around $12 million. We don't have any cash taxes to speak of. Franchise tax equals $1.5 million a year. So we're very strong from a free cash flow generation perspective, and all of our free cash now is going to be used to, one, delever, because we have the ability to go out into the open market and buy back our bonds. We haven't done any of that yet this year because our bonds are trading so high. They're trading at close to 107, but markets change, and we assume that over the next 5 years, because we don't have any maturities until then, sometime in the future we'll have that ability to do that. And if not, we'll just use our free cash flow to delever on a net basis and invest it in our digital businesses, because our digital businesses are growing tremendously. As Bill mentioned several times, they're double-digit revenue growth and double-digit profit growth, and it's really the engine that's driving this company going forwards, and it differentiates us from everybody.
Okay, I'm going to remind everybody that I'm going to take one or two more questions. So if you wanted to send in another question, now will be the time to do that. Bill, while we wait and see if we have an additional question or two, let's talk a little bit about your West Coast office that you'll be running, starting up in 2022. Obviously, you already have an office out in Charlotte, but how do you plan to integrate those offices? How West Coast is going to concentrate? Is it going on the West markets, or how are you dividing up the country, so to speak, with your offices? And are they going to mimic each other? In other words, have the same abilities that the Charlotte office has? So if you can just kind of give us your strategy on your West Coast offices.
Yes, and for those who aren't maybe as familiar to our transformation, Townsquare Interactive, we started organically. One of the greatest assets of the company, I talked about our greatest asset being our people. And within that, we have a core engineering and product team that actually built our CMS and built Townsquare Interactive solutions. So we started Townsquare Interactive organically with literally 3 people in 2012. And as I noted earlier on the slide, we have over 600 people in Charlotte today, and that's all disciplines. And to your question, Michael, we plan to mimic on the West Coast what Charlotte is on the East Coast. So that means we're going to have an inside sales team out there. We're going to have customer service. We're going to have what we call specialty disciplines, so search engine optimization, design, copywriting, photography. In essence, replicate what's in Charlotte with our 600 people on the West Coast. So I expect, it took us 9 years to grow from 3 people to over 600. So I expect us to be at that size scale, over the next decade on the West Coast. And yes, we will there. One of the things that we saw as an opportunity is we've time shifted of having people in Charlotte work different hours, but the ability to have customer service and sales focused on the West Coast time zones and even Mountain, based on our research that we've done, will be an advantage versus how we've been doing it to date. So really excited about opening that. We've actually hired, I believe now it's somewhere between 2 to 3 dozen, so 25 to 35 people already based there virtually. Stu and a number of people are in the final stages of picking our real estate out there. And so we'll probably be opening, as I mentioned, the end of Q1, beginning of Q2, but couldn't be more excited and already hiring in advance of that. And we just see this, this total addressable market of 32 billion. We're approaching, 100 million, but that's just a pit stop to hopefully $500 million and $1 billion over time. So the market opportunity is significant. We feel like we have a differentiated solution at a highly competitive price point. So couldn't be more excited about the business.
So another question is about Townsquare Interactive. 57% of your business, you say, comes from your in-market where you have radio stations. Was just wondering, is there any difference between whether it be in margins or maybe the touch points with the clients being in market with your business of Townsquare Interactive versus out of market? Any difference in between those customers, margins, or whatever?
Yeah, so just as a point of clarification, 57% are actually outside the radio markets, 43 are in. And over time, just based on our size sales force and based on the fact that we're literally calling hundreds of markets, but they're all outside the top 50, I expect that margin, that percentage to grow 60, 70, 80% over time. And we built some really unique software proprietary to ourselves, utilizing that engineering team to drive prospecting and drive new verticals for us. So in terms of your specific question, there really is no difference between an in-market and an out-of-market. There is a difference in terms of touch point, right? So as I mentioned earlier, I may have said it quickly, this is the only product at scale that we have 2 distinct sales teams to our. We have it on the street, in our local markets, hundreds of salespeople in our 67 markets calling on SMBs and providing the solution. But then we have an inside sales team in Charlotte, and now we're building one on the West Coast team. So that's really the only piece of the company that we're doing that. We're actually testing that with Ignite, which I've mentioned publicly, and it's off to a good start. But in terms of who we target, in terms of the average price point, in terms of the margin, I would think of them as the same. It's just simply somebody who's in our radio market versus outside of our radio market.
Thank you for joining us for this virtual roadshow presentation brought to you by ChannelChek. View our YouTube channel for more video content, including C-suite interviews, virtual roadshows, and conference presentation replays. New content is added regularly, so subscribe below to stay up to date. Visit channelchek.com or click the link in the description to access equity research, news, and advanced market data on this and 6,000 other small and micro-cap companies.